Have you ever dreamt of achieving true financial freedom, a life where money is no longer a source of worry but a tool to build your dreams? That's the power of long-term investing, and it's a journey we're embarking on together. We're going to talk about how to make your money work for you, not the other way around. Remember, in the world of investing, time is your greatest ally. It's not about getting rich quickly, it's about making smart, informed choices that will pay off over time. Throughout this video, we'll equip you with the knowledge and strategies to navigate the world of long-term investing successfully. Let's get started. Before we even consider investing, we need to talk about getting your financial house in order. That means tackling any debt you may have, credit card debt, personal loans, anything with high interest rates. You're throwing money away on interest payments that could be growing for you. Next, build your emergency fund. Aim for 3 to 6 months of living expenses in a readily accessible account. This isn't your investment money. This is your peace of mind money. These steps provide the firm foundation you need to start investing with confidence. Once you've taken care of these essentials, you're ready to move on to the exciting part, building your investment portfolio. Now let's talk about time, your secret weapon in the investing world. Investing is a long game, and the sooner you start, the more time your money has to grow. That's the magic of compounding, earning returns on your returns year after year. Your time horizon is the length of time you plan to keep your money invested before you need it. Are you saving for retirement in 20 or 30 years? That's a long-term horizon. Saving for a down payment on a house in 5 years? That's a shorter-term horizon. With a longer horizon, you can ride out the ups and downs of the market and take on more risk, potentially leading to higher returns. Remember, investing isn't about timing the market, it's about time in the market. There are countless investment strategies out there, each with its own set of rules and potential outcomes. It's easy to get caught up in the excitement of the latest market trends, but I can't stress enough the importance of consistency in your investment strategy. Jumping from one hot stock tip to another might feel exhilarating in the short term, but it rarely leads to long-term success. Develop a well-defined investment plan that aligns with your financial goals, risk tolerance, and time horizon. Once you've established your strategy, stick to it, even when the market gets bumpy. Don't let short-term market swings derail your long-term financial plan. Review your portfolio periodically to ensure it still aligns with your goals. Before you even think about investing, you need to ask yourself, what are my financial goals? What do I want to achieve with my money? Do you dream of owning a home, retiring early, traveling the world? These aspirations may seem distant now, but defining them is the first step toward making them a reality. Once you've identified your goals, write them down and be as specific as possible. Having well-defined goals will guide your investment decisions and keep you motivated on your journey to financial freedom. Now that you have a clear picture of your financial aspirations, let's categorize them. Divide your goals into 3 categories: short-term, medium-term, and long-term goals. Short-term goals are those you aim to achieve within the next year or two, like buying a new laptop or taking a vacation. Medium-term goals span from 2 to 5 years, such as purchasing a car or making a down payment on a house. Long-term goals typically take 5 years or more to achieve, including retirement planning or funding your children's education. By assigning a time frame to each goal, you can determine the appropriate investment strategies and risk levels for your investment portfolio. Remember, your goals are unique to you, and there's no one-size-fits-all approach. Now it's time to get down to the numbers. How much money will you actually need to achieve each of your financial goals? This is where careful planning and realistic estimations come into play. Consider factors like inflation, which erodes the purchasing power of money over time. What might cost $50,000 today could easily cost $75,000 or more in 10 years. Factor in potential lifestyle changes or unexpected expenses that might arise along the way. Flexibility is key in financial planning. This step might seem daunting, but it's essential for creating a roadmap to financial success. Now that you have a solid grasp of your financial goals, let's break down the financial planning process into 3 manageable steps: assess, strategize, and manage. First, assess your current financial situation. This involves creating a comprehensive budget that tracks your income and expenses, analyzing your assets and liabilities, and reviewing your credit report. Next, strategize. Based on your assessment, develop a personalized financial plan that outlines your investment goals, risk tolerance, and time horizon. Finally, manage your finances proactively. I can't emphasize enough the importance of starting early when it comes to investing. Time is your greatest asset, and the sooner you begin, the more time your money has to grow. Imagine two investors, both aiming to retire at 65. Investor A starts investing $100 a month at age 25, while Investor B waits until age 45 to start investing $200 a month. Assuming a 7% annual return, Investor A will have significantly more money at retirement, despite contributing less overall. This is the power of compounding. When it comes to long-term investing, it's essential to choose investments that align with your financial goals, risk tolerance, and time horizon. Remember, diversification is key. Don't put all your eggs in one basket. Stocks or equities represent ownership in a company. They offer the potential for high growth but also come with higher volatility. Bonds are debt securities that represent a loan made by an investor to a borrower, typically a corporation or government entity. They generally offer lower returns than stocks but provide more stability and income. Carefully consider your investment options and seek professional advice if needed to make informed decisions. When it comes to investing, fees matter. Even seemingly small fees can eat into your returns over time, so it's essential to understand the fees associated with different investments. Mutual fund fees, for instance, can vary significantly. Expense ratios, loads, fees charged when you buy or sell shares, and 12b-1 fees, which are annual marketing or distribution fees, can all impact your net returns. Exchange-traded funds, or ETFs, typically have lower fees than mutual funds, making them an attractive option for cost-conscious investors. Remember, every dollar saved on fees is a dollar that stays in your pocket and compounds over time. Mutual funds can be a valuable addition to a diversified investment portfolio, but with thousands of funds available, choosing the right ones can feel overwhelming. Start by considering your investment goals and risk tolerance. Are you looking for growth, income, or a combination of both? What level of volatility are you comfortable with? Look for funds with experienced managers, low turnover rates, which can indicate lower trading costs, and investment strategies that align with your goals. Consider diversifying across different asset classes and investment styles. Remember, past performance is not necessarily indicative of future results, but it can provide insights into a fund's track record and management team. Investing for the long term is a journey, not a destination. It requires discipline, patience, and a commitment to your financial goals. Remember to review your investment portfolio periodically to ensure it still aligns with your goals, risk tolerance, and time horizon. Make adjustments as needed, but avoid making impulsive decisions based on short-term market fluctuations. Stay informed about market trends and economic conditions, but don't let the noise of the market distract you from your long-term investment strategy. By following these principles, you can set yourself on the path to financial freedom and achieve your financial aspirations. Now let's address some common questions about long-term investing. What if I'm starting late? It's never too late to start investing. While starting early offers the most significant advantage, even if you're starting later in life, the power of compounding can still work in your favor. How much should I invest? The amount you invest will depend on your financial circumstances, goals, and time horizon. Start with what you can comfortably afford and gradually increase your contributions over time. What if the market crashes? Market corrections and crashes are a normal part of the economic cycle. By staying the course and remaining committed to your investment strategy, you can weather market storms and come out ahead in the long run. Congratulations, you've now gained valuable insights into the world of long-term investing. By implementing the strategies we've discussed, you can take control of your finances, build a secure future, and achieve your financial dreams. Remember, the journey to financial freedom is a marathon, not a sprint. Stay informed, stay focused, and never underestimate the power of long-term investing.